The shocking truth is revealed. I'm your host, Steve Metre, and thanks for joining me today. In our show today, a Fed cover-up reveals that the banks are on the brink of insolvency. And what I want to understand is that every year the Fed puts the banks to the test, and despite that, they couldn't see the banks that were about to fail back in March of 2023. And once again, the Fed is trying to convince us that the banking system is sound and solvent. And as you're about to see, they're on the brink of failure once again. Now it's over to Bloomberg, where we picked today's story up with a headline: "It's big bank sail through stress test and hairbringer for payouts." And that's exactly what the Fed wants you to believe, that there's nothing wrong with the banking system. Because if people started to believe there was a problem with the banks, they would start to pull their money out. And that's a big issue for a system, that there's not enough money to cover all the debts. So the banks need assets, they need deposits in a big way. And yet now the Fed's giving them the all clear. Of course, we know the banks want to just return capital to shareholders in a big way. As each firm stayed above its minimum capital requirements during a hypothetical recession, the Fed said in a statement back on Wednesday. And altogether, the group would take nearly $685 billion in losses, driving a larger drop in capital than last year's scenario, but, quote, within range of recent stress tests. Of course, the problem is, what if it's far worse than the Fed is testing? Or even beyond that, what if it's something the Fed isn't checking for? And that is the issue, because the Fed says everything's A-OK. In this round of annual exam, a product of the 2008 financial crisis, which of course the Fed didn't see coming. And here's the first problem. This included 31 banks, each with at least $100 billion in assets. And the problem then becomes is, what if it's all about banks that have under $100 billion in assets? Well, you're starting to see the Fed isn't concerned about them, which is why they didn't see what was coming in March of 2023. And they're not going to see it again. And yet we're making the case why a lot more banks are right on the brink of insolvency as the Fed turns the other way. And for the group as a whole, the so-called common equity tier 1 capital ratio, considered the highest quality regulatory capital, would bottom out at 9.9%, well above the 4.5% minimum requirement. The goal of our test is to help ensure that banks have enough capital to absorb losses in a highly stressful scenario. This, according to Michael Barr, the Fed's vice chair for supervision. This test shows they do. And it goes to show that the Fed really doesn't understand the banking system, even though they are a domestic banking regulator. And this is a problem, because anytime there's an issue with the banks, the Fed solution is always the same thing. Well, maybe if they just had more capital. So the idea here is the biggest 31 banks, they need to have enough capital to offset a recession. The problem then is, well, what about the banks that don't fall under the stress test? And this year's severely adverse scenario included a 10% peak in U.S. unemployment, something the Fed says is not going to happen. In fact, they believe it's going to peak at 4%, a 55% drop in equity prices, which nobody says is possible, and a 40% decline in commercial real estate prices, which is highly probable with what's going on in commercial real estate. As with last year, a subset of firms with large trading businesses faced an additional, quote, global market shock component involving equity price declines, a sharp rise in short-term treasury rates, and even a weaker dollar. But one thing that's notable here is this stress test seems to be all about a decline in asset prices. The real issue is what happens when people stop paying on their bills, because can the banks survive that? Well, I doubt it. The Fed also flagged a potential risk tied to big banks' exposure to hedge funds, citing additional analysis that doesn't count toward capital requirements, proving that a number of hedge funds could even fail, which is highly likely during the next crisis, and yet somehow the banks are going to emerge completely unscathed from this, and maybe even look really good. And something that should look good is your trading account, because if you're getting tired of seeing headlines like this, where oil prices near a 2-month high over Middle East tensions, and you said, why didn't I buy crude oil? And yet back earlier this month, about 17 days ago, on June 12th, we told our subscribers, look, it's time to buy oil. The setup is fantastic. And right now, as of Friday's close, you'd be up 3.59% on that trade. And here's the best part. I just had my programmer finish building a backtest engine that matches with all of our data set and how our reports are generated. And we're now going to start running tests against every signal CTA Timer Pro generates. We're going to find out which ones give you the best day trades, week trades, trades, month trades, quarterly trades, whichever it is, we're finding out. We're going to give it to all of our subscribers at no additional charge. But if you're not a subscriber, well, price is going up because we're going to teach you every day how to beat the machines, and we're going to give you all the data to trade successfully the way you want to. Links in the description below. Get it, because once we're done, the price is going up and our subscribers are going to make even more money. We don't want you to miss out, because Wednesday's results underscore the usefulness of extra capital that the banks have built in recent years above their minimum requirements. Now the question is, why are banks doing this? Because normally you'd think if there's a minimum, though, they would just achieve that. In reality is the biggest banks don't want to be at the forefront of the next financial crisis. They didn't intend to be part of the 2008 and 9 crisis, but they ended up there, and they don't want to be there again. So they're pushing the risk on all the small and mid-sized lenders, the shadow lenders. They're pushing risk everywhere out, even onto investors, anyone but them. And to show the world that they're solvent and in great position, well, it's simple. Just have a little extra capital, because, well, that's what the Fed says you need. And because of that extra capital cushion, we expect that large banks would be able to continue. And here's really where we talk about the cover-up. Continue extending credit to households and businesses during the time of financial stress. And what do banks don't do during times of financial stress or crises? Extend credit. They close the doors on those deals. Say, look, you want to borrow money? Not right now. And that's really the issue in a debt-based system, is you need the banks continuing to extend credit and originating new loans, which creates money into the system. Because if they stop doing that, that's where all the problems start to begin. And here the Fed saying, look, the market can crash, unemployment can go up, and housing prices can tumble, commercial real estate prices can implode, and hedge funds can fail. And yet for some reason, the banks are still going to send out money during this condition to people who want to borrow. If you believe that, well, that's not going to happen at all. And historically, it doesn't. Because bank bosses launched a lobbying blitz arguing they already have enough capital and the new rules would hurt consumers and businesses. Really, it's going to hurt shareholders because they want to push more money back in share buybacks. They push for major revisions or scrapping the plan entirely, even though Fed Chair Powell said there would be broad and material changes. But Barr reemphasized the need for banks to hold on to more capital in a statement on Wednesday. He attributed the higher losses this year to higher credit card balances, and here's a big one: delinquencies, riskier corporate credit portfolios, and a combination of higher costs and lower fee revenue in recent years driving less net income to counter losses. Those three factors suggest required capital buffers should be larger. And the real issue here is the Fed knows that the banks are going to be at the center of the next financial crisis. This isn't a surprise in how the system works. They just don't want to go to Congress and have to explain why they can't see problems coming, even though they are indeed the domestic banking regulator. So by increasing capital requirements, it's real simple. There just won't be a problem with the banks. Well, that is until there is. The biggest U.S. banks have signaled optimism about their capital levels this year, ramping up buybacks, which is really what the banks wanted to do, even ahead of the stress test results. The 6 largest lenders bought back more than $14 billion in stock in the first quarter, a whopping 73% jump from the pace in the second half of last year. Executives have touted excess capital in recent months, including a surprise dividend hike at J.P. Morgan. The CEO Jamie Dimon said it was because our capital cup runneth over, and reality is they're just going to issue themselves more, of course, shares and then buy them back so they can put money in their pockets. That's what this is all about. And if the system fails, well, don't worry. The Fed's going to bail them out anyways. The problem is it's the banks that the Fed's not looking at that's the problem. Even as banks breeze through, the stress tests are still subject of intense debate among economists and policymakers, and for good reason. The stress tests don't seem to find any problems, and yet we continue to have problems periodically in the banking system. To what good is the test? Of course, it's an open book test. You may not believe this, that the Fed gives the banks a test ahead of time. And then, of course, the banks just have to solve the problems to show they're in good shape. Excess volatility in the Fed's models mean the scenarios and exams should be subject to greater public scrutiny, according to Francisco Covas, the head of research at the Bank Policy Institute. And there's good reason why the banks stop lending during the next recession, and even worse, during the next financial crisis, is because what happens during crises, banks banks tighten lending standards. And one of the problems we have right now is we're not in a crisis. We're not in a recession. Now, arguably we're in the beginning of a recession. That we can see. But the banks aren't really extending credit now. So when we are in a recession and asset prices are falling, the notion that the banks are going to be extending credit is quite ridiculous, because banks don't want to lend on depreciating assets unless a borrower puts down a massive amount of down payment, which they're not going to do, or agrees to rather large payments, and they're not going to do that either. And here we can see right now commercial industrial lending shown on a year-over-year rate change in red. This is the weekly data, is just slightly above zero. So right now we're not in a crisis, we're not in a recession, and the banks already aren't lending. But what happens is, as financial conditions tighten when we head into a recession, what happens? Banks cut back on lending. You see when that red line goes below the horizontal black line, that means on net, that means that banks aren't originating enough new loans to offset the number of loans being paid off, and you see it enter contraction. And for a debt-based economy, this couldn't be worse news, because that means money is being destroyed by the banking system. And when that happens, well, asset prices tend to come crashing down. And we can look at the other issue here, because the Fed's focused on 31 of the biggest banks. Well, what about the other banks? Because you talk about extending credit, which they say is going to happen during the next crisis, and of course it won't, because one thing the banks don't do is extend credit to people who are delinquent. And what happens, of course, during financial crises and recessions is people stop making payments and go into delinquency. Of course, that means there's not going to be any new credit issued. You go back to the global financial crisis, you can see the delinquency rate on all loans shot up to nearly 7.5%. I'm going to make the case of why that's headed higher this time, because when we look at continued unemployment claims in blue, you can see the relationship to the delinquency rate. So somehow the Fed says the test can handle a 10% unemployment rate, but in reality, it's not going to handle that at all, because when consumers stop paying on their debt, and that's the question I have for the Fed, did you model what happens if people stop paying on the debt? Because that's something the banks can't handle. And L. Arian says slowing economy raises Fed policy error risk as well, and a July interest rate cut is unlikely, he said, but it shouldn't be, and we agree. The economy is slowing faster than most economists expect, and faster than what the Fed expected. The price increase for personal consumption expenditures, or PCE, rose 2.6% year-on-year in May, the slowest rate so far this year, and in line with forecasts. The Fed is aiming with its interest rate increases of the past 2 years for an inflation rate averaging 2%. And here we can see the president of Queen's College at Cambridge said the economy is indeed slowing, and it has few buffers. A forward-looking Fed would certainly have the possibility of a July rate cut on the table. And that is absolutely true, because the Fed can't see that the labor market is starting to fall apart. And when it does, people are going to stop making payments on their loans. And when they do, the real question is going to become, can the banks actually tolerate massive widespread defaults? I don't think so. The Fed is at risk of keeping rates too high for too long, L. Arian said, in his view that the odds of U.S. recession are now 35% compared with a 50% for a soft landing. And I don't know what soft landing data he's looking at, but there's certainly no sign. The more likely error right now is the Fed will not start cutting early enough, which is what they normally fail to do, and eventually winding up having to cut rates more than they should. And that's exactly what happens each and every time the Fed starts to aggressively cut rates, because they're behind the curve. And we can see that, and we can see further evidence of what's causing problems in the banking system, because it's the Fed itself that's curtailing credit. It's just the economy, when it starts to deteriorate, that makes things even worse. So even if 31 banks did have enough capital, what about all the other banks that are likely to fail, the small and mid-sized regional banks, maybe even local credit unions that are overextended? You just really don't know how bad it's going to be. But here we can look at the yield curve. This is shown in red. This is 10-year yields less 2-year yields, and it's shown inverted when the red line is underneath the horizontal black line, and it inverts because the Fed artificially pushes the federal funds rate higher than market expectations. And because banks borrow at the short end of the curve, say at 2-year rates, and lend at long-term rates, well, when it's inverted, they have no incentive to lend, because they don't make money on the interest rate spread. They have to make money on other things, and so naturally what you see is they tighten lending standards. Here again, as we're looking at domestic banks tightening lending lending standards to firms of all sizes. And you can see that when the blue line is above the horizontal black line. And what that's telling you is the Fed has already put the banks in a situation where they don't want to lend now. Well, when we're in an all-out crisis, they're really not going to want to lend at all because they're going to see widespread defaults. We haven't even gotten to the dangers of what's going on in commercial real estate. But is the market giving the Fed the all clear to cut? Well, not yet. You notice the relationship between the federal funds rate and two-year treasury yields was fairly strong. And Fed says they look at unemployment, they look at the labor market, they look at inflation. No, they look at two-year treasury yields. And right now, the two-year yield has been attempting to tell the Fed multiple times they need to cut. And every time it goes down, the market says no, the Fed says not yet. And that's what Al Arian's suggesting is the Fed's going to be behind the curve here, and in a big way, because it's a commercial real estate crisis that's only going to be the one that takes down the banks the Fed isn't even paying attention to, as empty offices risk wiping out $250 billion in commercial property values, and this could get far worse. Nearly 1/4 of all U.S. office space will be vacant by 2026 as working from home persists. Why we're suggesting if you own some of the stuff, maybe it's time to get out. And if you look at what's going to happen, it could cut real estate values in that space by $250 billion, according to Moody's. And office vacancy rates are expected to rise 24% from 19.8 in the first quarter this year in the U.S., reducing revenue for office landlords between $8 to $10 billion when combined with the impact of lower rents and lease turnovers. The report said that in turn, this could translate into, quote, property value destruction. And that means the banks holding these loans, which are not the ones the Fed pays attention to, are looking at insolvency. And this could range in $250 billion. And what we know is this is going to be far worse than the banking system is prepared to handle, because the argument for maintaining or even increasing remote work practice remains compelling for many businesses. If productivity remains stable and costs can be reduced by foregoing physical office spaces, the rationale for mandating in-office attendance diminishes, and this trend will continue until we see the downtown areas of major cities all over the country are going to crumble. You're going to see municipalities struggling. Of course, they're going to need the tax revenue from these buildings, and their values are going to decline. You're going to see businesses go away. It's going to be bad news until somebody figures out that everyone needs to go back to the office. And using multiple sets of government and academic data, including the survey of working arrangements and attitudes, Moody's determined that office workers today need about 14% less office space than they did before the pandemic. The figure corresponds to research from McKinsey Global Institute, which concluded there will be 13% less demand for office space in a typical city all around the world by 2030. And they also found that office property values will decline anywhere between $800 billion and $1.3 trillion over that time period. And guess what? The big 31 banks aren't the ones that are holding all of this office debt. It's the small and mid-sized regional banks that the Fed isn't paying attention to, which is why we think they're closer to insolvency. But will the Fed act? As Fed's Daily says, the latest data show monetary policy is working. On the other hand, she says, we get inflation coming down like it did at the end of last year, and the labor market staying intact or falters, we can actually adjust policy to respond to that, because she believes that they actually control the labor market. Of course, earlier this week, she warned that the U.S. labor market is nearing an inflection point where future slowing could spur higher joblessness, and employers continue to add jobs at a solid pace. We'll see about that this Friday, but the unemployment rate hasn't ticked higher in recent months. Of course, we have the jobs report, which I believe will likely show the labor market continuing to deteriorate. This is something that does not really get a factor in the test. I know they factor a 10% rise in unemployment, but what happens when all these people stop paying on their bills? It's the small and mid-sized regional banks that go first, and then the spillover to the big banks, when we find out just how much real risk they're holding that doesn't show up in the test. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.